You work hard, you save money, you try to make smart decisions. Yet when it comes to investing, most people feel confused, anxious, and overwhelmed. One day the market goes up, the next day it crashes. Experts argue on television, friends give advice, fear whispers that you might lose everything. But what if the real danger is not the market? What if the real danger is how most people invest? The central idea of this book is brutally simple and deeply powerful. You do not need to beat the market to win. You only need to own it. John C. Bogle reveals that long-term wealth is not built through prediction, speculation, or clever tricks. It is built through patience, discipline, low costs, and common sense. When you stop trying to outsmart the market and instead invest in the entire market at the lowest possible cost, time and compounding begin to work in your favor. This book teaches you how simplicity consistently defeats complexity. Chapter 1. The case for index investing: simplicity and efficiency wins. Imagine playing a game where millions of highly trained professionals compete every single day, using the fastest technology and the deepest research. Now imagine trying to beat all of them consistently. That is exactly what most investors attempt when they try to pick winning stocks, and most of them lose. The question is not whether some people win, the question is why most people fail. This chapter reveals a hard truth. The market is not your enemy, but your unrealistic expectations are. Index investing is based on one powerful idea. Instead of trying to find the few winning stocks, you simply buy the entire market. By doing this, you automatically own the winners, the average performers, and the future champions, before anyone knows who they are. Bogle explains that markets are highly competitive and surprisingly efficient. Prices already reflect the collective knowledge of millions of investors. Trying to outguess this system usually leads to higher costs, higher stress, and lower returns. Index funds remove speculation, eliminate unnecessary trading, and drastically reduce expenses. Over time, these advantages compound into massive gains. Simplicity is not weakness. Simplicity is strength. When you invest in an index fund, you are aligning yourself with the long-term growth of businesses, innovation, and the global economy itself. You stop gambling, you start owning. But even if index investing makes sense, there is a silent force that slowly destroys returns without most investors noticing it at all. That invisible enemy is revealed in the next chapter, and it could be costing you more money than you imagine. Chapter 2. The power of low-cost investing: keep more of your returns. Imagine working for years, saving consistently, investing patiently, and then discovering that a silent leak has been draining your wealth the entire time, not because the market failed, not because you made bad choices, but because of something so small that you barely noticed it. A few percentage points, a tiny fee, a hidden cost. Over decades, this small leak becomes a massive loss. This chapter exposes one of the most important truths in all of investing. Costs matter more than almost anything else. Every dollar you pay in fees is a dollar that never gets the chance to compound for you. And compounding over long periods is the real engine of wealth. John C. Bogle explains that many investors obsess over returns while completely ignoring costs. They chase funds that promise higher performance, not realizing that higher fees stack the odds against them from day one. Management fees, transaction costs, sales loads, and taxes quietly eat away at gains year after year. Even when a fund performs well, its costs ensure that investors receive less than they should. Low-cost index funds flip this equation. By minimizing expenses, they allow you to keep the largest possible share of the market's return. You are not trying to win by being smarter. You are winning by refusing to lose unnecessarily. This is common sense investing at its core. The power of low costs becomes unstoppable over time. A small difference in fees might look harmless in 1 year, but over 20 or 30 years, it can mean the difference between financial independence and disappointment. Compounding works both ways. It magnifies growth, but it also magnifies costs. Bogle reminds you that investing is not about brilliance, it is about discipline. The fewer costs you carry, the lighter your investment journey becomes. Lower costs reduce pressure, they reduce risk, they increase certainty, they tilt the long-term odds permanently in your favor. But if markets are efficient and low costs are essential, a deeper question remains. If everyone already knows this information, why do so many investors still lose? The answer lies in how markets actually function and how human expectations clash with reality. That truth is uncovered in the next chapter. Chapter 3. The importance of market efficiency, embracing market realities. Every day, headlines scream about market crashes, sudden rallies, and the next big opportunity. Experts claim they know what will happen next. Social media is filled with predictions, and deep inside, you wonder whether you should act now before it is too late. But what if the market already knows everything you are trying to predict? This chapter introduces one of the most misunderstood ideas in investing: market efficiency. John C. Bogle explains that financial markets are not random casinos, nor are they easily fooled machines. Prices reflect the collective intelligence, expectations, and emotions of millions of investors across the world. Every known piece of information is rapidly absorbed into market prices. This reality creates a hard truth. If information is already priced in, consistently beating the market becomes extraordinarily difficult. Professional fund managers with massive research teams, advanced algorithms, and instant access to information struggle to outperform over the long term. For individual investors, the odds are even worse. Market efficiency does not mean markets are always correct in the short term. Prices can overshoot, emotions can dominate, bubbles can form, crashes can happen. But over long periods, markets tend to reflect economic growth, corporate profits, and real value. Trying to exploit short-term mispricing usually leads to higher costs, emotional decisions, and poor timing. Bogle urges you to stop fighting reality. Instead of trying to outguess the market, you align yourself with it. By owning the entire market through index funds, you accept uncertainty while benefiting from long-term growth. You remove the burden of prediction and replace it with patience. This mindset shift is liberating. You no longer panic at daily movements. You no longer chase hot trends. You stop reacting and start investing. You trust the system not because it is perfect, but because it is more reliable than human ego. But accepting market efficiency demands something rare and uncomfortable. It requires patience, it requires time, and it requires the ability to stay calm while others panic. In the next chapter, Bogle reveals why long-term thinking is not just helpful, but essential for winning the investment game. Chapter 4. The long-term perspective, the virtue of patience. Every investor says they are in it for the long term, but the moment the market falls, fear takes control. Screens turn red, news turns negative, doubt creeps in, and suddenly patience disappears. The greatest enemy of wealth is not lack of knowledge, it is lack of endurance. This chapter reveals a truth that most people understand intellectually but fail to practice emotionally. Wealth is created slowly, then suddenly. John C. Bogle explains that markets reward those who give time the chance to work. Short-term movements are noise, long-term growth is the signal. History shows this pattern again and again. Markets rise, markets fall, crises appear, recoveries follow. Wars, recessions, inflation, political chaos, and technological disruption all come and go. Yet over decades, businesses adapt, economies expand, and patient investors are rewarded. The people who win are not the smartest or the fastest. They are the ones who stay invested. Bogle emphasizes that impatience leads to destructive behavior. Investors jump in after markets rise and jump out after markets fall. They buy high and sell low, exactly opposite of what they should do. This emotional cycle destroys returns far more effectively than any market crash ever could. Patience is not passive. Patience is disciplined action. It means continuing to invest regularly. It means ignoring daily headlines. It means trusting long-term fundamentals over short-term fear. When you combine patience with low-cost index investing, compounding becomes unstoppable. Time is the most powerful force in investing. It magnifies discipline and punishes emotion. The longer you stay invested, the less risk you face and the more certainty replaces fear. The market does not reward timing. It rewards participation. But patience alone is not enough. Even long-term investors can fail if their money is not structured correctly. How do you reduce risk while still capturing growth? The answer lies in how you spread your investments, and that is revealed in the next chapter. Chapter 5: Asset Allocation and Diversification. Reducing risk and enhancing returns. Two investors earn the same income. They invest the same amount. They even earn similar market returns. Yet years later, one sleeps peacefully while the other lives in constant anxiety. The difference is not luck, it is structure, how you arrange. Your investments matters more than which investments you choose. This chapter uncovers one of the most powerful principles in investing. Asset allocation drives outcomes. John C. Bogle explains that your mix of assets such as stocks, bonds, and cash determines most of your long-term risk and return. Trying to pick winning stocks adds noise. Choosing the right balance adds stability. Stocks offer growth but come with volatility. Bonds provide income and protection during market downturns. Cash offers safety and flexibility. When combined thoughtfully, these assets work together to smooth returns and protect you from emotional mistakes. Diversification is not about maximizing gains in good times. It is about surviving bad times. Bogle emphasizes that diversification works because markets are unpredictable. No one knows which asset will perform best next year. By owning many assets across sectors, industries, and geographies, you reduce the damage caused by any single failure. When one part struggles, another often stabilizes the portfolio. Asset allocation must match your temperament, time horizon, and ability to handle risk. A young investor can afford volatility. A retired investor needs stability. The wrong allocation leads to panic selling at the worst possible moment. The right allocation gives you the confidence to stay invested. Diversification is humility in action. It admits that the future is uncertain and prepares for it anyway. When combined with low costs and patience, it transforms investing from a stressful gamble into a controlled, rational process. Even with perfect diversification, many investors still fail. Not because of markets, but because of their own behavior. Fear, greed, and emotion silently sabotage progress. The next chapter reveals the most dangerous psychological traps and how to avoid them. Chapter 6: Common Pitfalls and Behavioral Traps. Avoiding Costly Mistakes. Most investors believe their biggest risk is the market. They fear crashes, recessions, and uncertainty. But history proves something far more dangerous: the investor themselves. The greatest losses are not caused by markets. They are caused by behavior. This chapter exposes the psychological traps that quietly destroy wealth. John C. Bogle explains that human emotions evolved for survival, not for investing. Fear, greed, overconfidence, and herd behavior push people to make decisions at exactly the wrong time. When markets rise, excitement takes over. Investors chase hot stocks and popular funds, believing success will continue forever. When markets fall, panic dominates. Investors sell at the bottom to escape pain, locking in losses. This emotional cycle repeats endlessly, turning investing into a losing game. Another trap is overtrading. Many investors believe activity equals intelligence. They buy and sell frequently, trying to capture small gains. In reality, each trade increases costs, taxes, and mistakes. The more you trade, the more you transfer wealth away from yourself. Bogle also warns against overconfidence. The belief that you are smarter than the market leads to concentrated bets and unnecessary risk. Even professionals with vast resources struggle to outperform consistently. Humility is not weakness. Humility is protection. The solution is simple but not easy. Create a disciplined plan, choose low-cost index funds, set a rational asset allocation, and most importantly, stay the course during both euphoria and fear. When you remove emotion from decisions, your odds improve dramatically. If avoiding mistakes is so important, what does the future hold for investors who embrace common sense? How does this philosophy survive changing markets, new technologies, and evolving financial products? The final chapter reveals the answer. Chapter 7. The Future of Investing. Continuing the legacy of common sense, the world of investing is changing faster than ever. New products appear every year. Algorithms trade at lightning speed. Social media turns speculation into entertainment. With so much noise, it is easy to believe that old principles no longer apply. But do timeless truths ever expire? In this final chapter, John C. Bogle reminds you that while markets evolve, human nature does not. Fear, greed, hope, and impatience remain constant. That is why common sense investing will always matter. The future will bring new platforms, new tools, and new financial innovations, but the core principles that build wealth will remain unchanged. Low costs will continue to outperform high costs. Diversification will continue to reduce risk. Patience will continue to reward discipline. And index investing will continue to provide a reliable path for ordinary investors to achieve extraordinary results. Bogle warns that complexity often disguises itself as progress. Many new investment products promise higher returns, smarter strategies, and better timing. But complexity increases costs and amplifies mistakes. The simplest approach often delivers the most consistent outcome. The future belongs to investors who resist hype and embrace discipline. Those who ignore noise and focus on long-term ownership of productive businesses will benefit from economic growth, innovation, and compounding. Investing is not about predicting the future. It is about preparing for it. Common sense investing is not exciting, it is not glamorous, but it works, and over decades, it quietly transforms effort into freedom. This book teaches you that investing success is not about brilliance or luck. It is about behavior. It is about choosing simplicity over complexity, patience over panic, and ownership over speculation. When you follow these principles, the market works for you, not against you. Final thoughts. Most people search for investing shortcuts for their entire lives. They look for signals, secrets, and strategies that promise fast results. This book delivers a harder truth, but also a far more powerful one. Wealth is not created by brilliance. Wealth is created by discipline, patience, and consistency over time. John C. Bogle teaches you that investing is not a game to be beaten. It is a system to be respected. When you stop fighting the market and start owning it, everything changes. You no longer chase trends. You no longer panic during downturns. You stop reacting emotionally and start thinking like a long-term owner of real businesses. The most important lesson of this book is not about index funds. It is about behavior. It is about controlling costs when others ignore them. It is about staying invested when fear dominates headlines. It is about trusting compounding when results feel slow and invisible. Common sense investing does not promise excitement. It promises freedom. Freedom from anxiety. freedom from constant decision-making, freedom from the pressure to be right all the time. Over decades, this freedom compounds into financial independence. The market will rise, the market will fall, crises will come and go. But if you stay the course, reinvest returns, minimize costs, and remain patient, time becomes your greatest ally. In the end, investing rewards those who endure, not those who predict. This book is not about beating others. It is about securing your future, and the future belongs to investors who choose common sense when everyone else chooses noise. If this summary changed the way you think about money, discipline, and long-term success, then you already understand the most powerful investment of all, your mindset.